Dividends have become one of the most researched investing topics, and the popularity of dividend ETFs is for good reason. Dividends can be a significant contributor to an investor's overall total return. In one study of equity returns over a 200-year period, dividends accounted for a whopping 75% of the total annualized return of stocks. Today's audience-requested ETF battle is a triple header between three dividend-focused ETFs. One is from Nationwide, the other JP Morgan, and Amplify. Stick around. Welcome to ETF Battles. I'm Ron DeLegge. Thank you so much for joining us. Be sure to subscribe to our channel and press the like button if you've been enjoying the show. If you have a certain ETF battle that you'd like to see, give us your ticker symbols in the comment section below or on our Twitter feed at ETF Guide. And again, make sure you give us those exact ticker symbols. If we choose your battle, you win your choice of an ETF Battles coffee mug or a t-shirt. Now, today's ETF battle was requested by Echo6350. It's a dividend bout between income-focused ETFs from Amplify, JP Morgan, and Nationwide. Now, this is JEPI, NUSI, and DIVO, DIVO, going head-to-head. Congratulations, Echo. You win an ETF Battle shirt because we chose your contest. So just hit that comment section below to claim your prize. Helping us to judge today's skirmish is Eric Balchunas at Bloomberg and Todd Rosenbluth with CFRA Research. Guys, welcome back. Great to see you again.
Great to be with you, Ron. Good to see you again, Eric.
Likewise. Good to see both of you guys.
I forgot to mention that both Eric and Todd have been doing a great job covering the meltdown in Russian markets and the ETFs tied to them. Todd was in a recent Wall Street Journal article. Also, Eric has a new book coming out in April titled The Bogle Effect. It's available at Amazon.com, so be sure to reserve your copy. So we've got our four battle categories: cost, exposure, strategy, performance, and yield. And then we've got our mystery battle category where you, our judges, can pick that single factor or multiple factors that you feel are important to today's matchup. And who knows, that mystery category could end up deciding which of these ETFs wins the battle. I've got the scorekeeping chores, and we'll go through each one of these four battle categories one at a time, giving our judges an opportunity to weigh in. Let's start with the first category, which is cost. Todd, please get us started.
Yeah, so we focus on the expense ratio, with JEPI being the cheapest of the three products at 35 basis points. All of these ETFs are, have higher expense ratios than your broad beta oriented ETFs, again, because of the covered call options behind it. But JEPI would be my winner here, JEPI, at 35 basis points.
Thank you, Todd. We next shift to Eric. How do you see it in terms of cost?
I'd have to agree. It's not really even that close. It's 55 for DIVO, 35 for JEPI, and 68 for NUSI. 35 is pretty good for, I call these strategies package trades. In other words, they're serving up something and then they're doing this other thing and this other thing, sort of like A plus B plus C. And so that's worth something. And so 35 bips to me is pretty reasonable for this. So it's actually cheap, I would say. I think 55, 68, the other two are more like average. JEPI is an exception at 35, and so I'd have to easily give it to JEPI.
That takes us to our next category, exposure strategy. Eric, you're still up. Give us your analysis.
Yeah, so these all do some different things. DIVO, look, is going to pick the 20 to 25 potentially outperforming dividend stocks, so it's very concentrated. It's going to look inside the S&P 500 to get that. And then it's going to write options on that, which essentially means that you get paid for writing the option. But if DIVO goes up a lot, you have to sort of make good on that option, and you limit your upside. So you get the premium is the benefit. It's like being an insurance company, and the event would be if DIVO goes up, you have to pay and basically sell your shares at that lower price. So that's what you're giving up. You're giving up upside for income, and that's what all of these are sort of doing. JEPI, I think, is the same thing. It's on the S&P 500, but it holds 100 stocks about. And NUSI is on the NASDAQ 100, so it's also 100 stocks, but it's the NASDAQ 100, so it's predominantly tech stocks and sort of innovative type companies. So I look at all this, and they all have their benefit. I would give the edge here to DIVO simply because of the sectors that it holds. It holds some more sectors that are emerging this year and in the past year. So like it holds a lot more energy. It's giving it a lower price to earnings ratio. JEPI is a little more, slightly more into a tech and consumer stocks. And then NUSI is almost all tech, or like a big majority, because it's the NASDAQ 100. And so I just think DIVO this year would probably get the edge because it happens to be in sectors that are in favor and sectors that have beaten up for 10 years. So it's possible those sectors are on like a nice, they're going to be the leaders of the new regime. And I think you have to consider that. So I guess your view on the NASDAQ and tech stocks should play in here, but I would give DIVO the edge here on exposure.
Todd, how do you see it in terms of exposure strategy? Do you agree with Eric's analysis?
Well, I think Eric did a great job of laying out the facts about the different strategies, how they are different from one another. A couple of things down there. NUSI is index-based, or at least in the securities. It's tracking the NASDAQ 100. JEPI and DIVO are actively managed. My vote is going to go with JEPI because it's more broadly diversified. So you're getting the benefits or the potential benefits of active management from the JP Morgan research team, but you're not as concentrated on a couple of dozen stocks, a broader basket of 100 stocks if you're thinking of this as fitting into the portfolio. So that diversification from the exposure standpoint is more compelling to me than more concentrated, but I understand where Eric's coming from.
Thank you, Todd. That takes us next to performance and yield. Todd, you're still up. Give it to us.
Yeah. So again, yield fits into this because it's the income that you're getting from the covered call strategies. JEPI is my winner on this one also. It's outperformed in the period of time, the year that it was around, which overlaps with what DIVO and NUSI had. NUSI actually was negative in the past year. The NASDAQ performance in the past year plays a role in that. It does not have a 3-year track record. That's both incredible as to how much the assets it's gathered, but it doesn't have a long enough record. So we don't have concerns about that, but I understand why others might. So where I can do apples to apples, JEPI is my winner. But yes, you get longer track records from the two other products.
Thank you, Todd. Eric, your take on performance, how do you see it?
JEPI, well, I will say JEPI over the past year is up like 13.9% and DIVO is up 13.4%. I would probably call that a tie, although they're both clearly beating NUSI. So I think you have to at least go tie there, but I guess you give JEPI the edge because if we're talking performance and yield, JEPI's yield is a little better than DIVO. So we've got 7.5% yield for JEPI and only 5% for DIVO. That said, NUSI is yielding 8.75%. But here's the thing. What's the point of getting a lot of yield if it's not enough to actually give you a positive total return? That sort of just makes no sense. So at least the other two, their yields are on top of some price return action or some positive price return. So I guess I'd give it to JEPI all in, with all that considered.
That brings us to our next category, one of my favorites, the Alfred Hitchcock category. That's the mystery, where our judges can pick that single factor or multiple factors to make their arguments. So, Eric, what is your mystery battle category and who wins it?
I'm going to go with percentage of stocks that are value versus growth. DIVO has 71% of its portfolio are value stocks, whereas JEPI is 43% and NUSI is almost non-existent. I got to give it to DIVO. I feel that we are on a long-term trajectory where value is going to continue to excel in this market. It's had some stumbles, but I can tell from the flows and the sentiment out there, people really believe value's time has come. And so I think for that reason, I give it to DIVO. That said, JEPI is even value growth, so it's not all growth. And so I think it's a close call, and JEPI, I think, is more balanced, as Todd said. It's more diversified. I think DIVO, you're making a little bit more of a bet on value. There's a concentrated bet and a bet on energy. And I think that's what you have to consider. But I like all those things. So I picked DIVO for that reason in this environment. But that doesn't mean JEPI, I think, isn't also good. I want to make that clear.
Very good. That's a solid argument. Thank you, Eric. Todd, how do you see it in terms of your mystery battle category? What is it and who wins it?
These are relatively complicated ETFs, as Eric had a tighter way of describing it, but these are equity strategies with covered calls on top of it. So you're adding a layer to it. So my mystery battle category is actually going to be simplicity. And I would give the vote to NUSI on that one because it's the NASDAQ 100. You know what you're going to get, whether or not it's too much technology and too much growth oriented stocks. That's for an investor to determine. But you'll know what's in that, and you'll know what's in that 6 months from now and 6 months forward. You may not know how it's going to perform or the income, but it's simple enough to understand. It's got a slightly more complicated strategy than owning the NASDAQ 100. But I like that simplicity with these more complicated products. So NUSI is my mystery battle category for that aspect.
Thank you, Todd. Now we shift to the part of the program where we give our judges a final opportunity to give us their overall battle winner. Todd, give it to us.
My winner is going to be JEPI. It's cheaper than the three or the two other products. It has a slightly stronger performance record. I like the exposure that it's diversified, as Eric used great data on a mixture of growth and value-oriented stocks. It's a little bit more complicated because if it's actively managed, but JEPI would be my winner here. But these are all three really great products that have gained investor attention in the last 3 years and are all worthy of additional homework by the viewers.
Eric, your final opportunity to weigh in.
I would give the edge to DIVO for myself, although if my mom came and asked me what to do, I would recommend JEPI. So I want to basically make that clear. The reason DIVO, I'm a fan of the concentration of this fund. It's got less stocks. 57% of the portfolio is the top 10. And I personally, if I'm adding this on top of a boring vanilla core, I kind of want a little zip, a little risk. And I like the value tilt. That said, JEPI, I think for an older investor, probably better because of that balance. So I would give DIVO the nod, but with the edge overall. But I would say both the other ones I think are very good. But JEPI in particular, I think is really good. And also you get the JP Morgan brand name. The other two don't really have that. That is something to say for that. And like I said, you're getting institutional level active management there. But I'm going to give the edge to DIVO.
Well, thank you, judges, for your excellent analysis. And according to my battle scorecard, this is a split decision between DIVO and JEPI. Each of our judges making some very convincing arguments. Eric liking the sector exposure to energy that's higher in DIVO. And the other two, JEPI and NUSI, are more focused on tech. Todd, of course, preferring JEPI's diversification. And also in the mystery battle category, a nice mention there for NUSI. Todd liking the simplicity of the strategy. But overall, this was an excellent battle. And you judges really broke it down, made it simple and easy for our audience to understand. And certainly with more complicated dividend income strategies like these, we need all the help we can get. So great job to Eric and Todd for breaking it down. Well done.
Thank you.
Thank you, Ron.
Which ETF battle would you like to see in our next episode? Well, post your ETF ticker symbols in our YouTube comment section below, or find us on Twitter at ETF Guide. And if we choose your battle, you'll win your choice of an ETF Battle shirt or a coffee mug. Thanks for watching. I'm Ron DeLegge. And until next time, watch the battle before you invest right here on ETF Guide TV.